Welcome, and thank you for joining us to explore the impacts of the coronavirus on one of your most vital general fund revenues. This is Denise Ovrum starting us off. Bret, Plumlee, and I are principals with HdL providing service to our sales tax clients. We both came from local government backgrounds, so we are intimately aware of the challenges ahead for local agencies during and recovering from this unprecedented health and economic crisis. So just some housekeeping items before we start. This webinar will be recorded and posted on our website. You will be muted during the presentation, and we will be taking questions at the end of the presentation. However, you can submit them as we move along. Just select on your screen, either at the top or the bottom, select question and answer. So moving forward, our forecast is based on several assumptions. Statewide shelter-in-place directive will continue to the end of May. And in fact, the Bay Area just extended theirs to the end of May today. The virus runs its course by the end of September, which is based on the trends reflected in China and South Korea. However, this is dependent upon citizens following the governor's 6-point plan and the expansion of testing. Sales tax and use tax declines are expected to continue through 2020, with moderate gains following in 2021. Our scenario's recovery is also projected a little sooner than we might have forecast otherwise, under the assumption that federal actions will prevent falling as deep as it did in 2009. Interest rates are low, and the decline in oil prices should further support the consumer. The resumption of previous spending patterns after income interruptions, furloughs, loss of jobs is not immediate and will evolve over time. Consumers often permanently convert discretionary spending to non-taxable services, activities, or online retail options, ones they discovered during the cutback. Deepest tax declines are expected in the restaurant, hospitality, travel, transportation, and brick and mortar retail segments, and those segments that provide supplies to retailers. Specific businesses and segments, restaurants, for example, and large retailers may not recover. The bottom line message is that there is a tremendous degree of unknown surrounding this virus outbreak and a wide range of possible outcomes. So moving along to the specific forecast trends. Keep in mind the forecasts we're going to be discussing today are statewide. They're based on extensive research, review of reports, data, projections in specific industries, and we are continuing to track it every update. This is evident as conditions have unfolded to date. We have continued to update our estimates. So, for example, our initial projection in early March reflected a gain of 1.9% in fiscal year 1920. We then revised it to a decline of 3.1 in mid-March. And as of our latest forecast, which is reflected in the data we'll discuss today, is down 9.5%. Stay in place in California commenced in mid-March, which reduced the impact in the first quarter. And therefore, the January through March quarter is expected to decline 7.5%. The biggest hit will be in the second quarter, and that's reflected in the line graph on the screen before you. As we will detail, all groups will be adversely impacted except for food and drugs and the countywide pools. As a result of this, the overall 1920 fiscal year estimate is a decline of 9.5%. It's not as gruesome as you might think due to the consistent quarterly year-over-year growth that preceded the shutdown. In addition, the increase in the pools came in the nick of time, which Bret will cover later. The following fiscal year 1.5 decrease reflects our assumption of reopening in June. While the recovery from the Great Recession, which was a crisis of the financial system, was long and slow, it is assumed this recovery will be quicker based on a stronger economy at the get-go. However, changing events inconsistent with our assumptions may necessitate a lower projection. Also, keep in mind individual agency impacts will depend on a number of factors, including the composition of their economic base. So, for example, those agencies that may be dependent on autos or on retail department stores.
Thank you, Denise. We're going to now start to go through every major industry group, and there are 7 major industry groups that we analyze, and additionally, we analyze the pool as well. So we'll start with autos and transportation. And just as Denise mentioned up front, when we began our forecast on March 11th, the forecast for this individual industry group, which has been hit extremely hard, first quarter 20 was down 0.5%, and second quarter 20 was down 2%. And as you can see on the slide in front of you, first quarter 20, we now are estimating negative 12%, second quarter 20, negative 55%, and a negative 6.3% for the entire fiscal year 2021. We are hearing from many city representatives as we do our quarterly meetings with all of you. Many local auto dealers have sales that are dropping down close to zero. Most dealers are closed completely for sales and only open to servicing the vehicles, and that only generates a small amount of sales tax, and that's mainly from the parts that are associated with the service. We developed our forecast for the autos and transportation at the beginning of April based on a variety of industry reports and published forecasts. During their lockdown phase, when we looked at the market in China, Chinese auto sales were down about 80%, and United States forecasting firms were also forecasting declines somewhere in that vicinity. We also received real-time information from one of our client agencies that has a large concentration of auto dealers that sales were down in that range, at least at the beginning of the crisis. We went with a forecast down more than 25% for all of calendar year 2020, and that is inclusive of the entire auto transportation group, which includes used cars, rental cars, and auto supplies. And we expected the lockdown to impact California a little harder, as California was the first to implement the stay in place. Experienced during the Great Recession, the worst year was in fiscal year 2008-2009, and had a decline of 25%. So we are definitely approaching, if not exceeding, the Great Recession impact. Since the very beginning of this crisis, industry forecasts have gone lower and lower as the weeks have gone by, and that is pretty much for every industry group that we're going to talk about today, not just the autos and transportation. It's something that we are monitoring, and we will adjust our forecasts quarterly as events unfold. And as Denise mentioned, and we've mentioned throughout, we as a team have adjusted our forecast downward twice already since March 11th. A lot is going to depend on how long this shelter will last, and that's certainly having a negative impact on the sales. But then, once the shelter is lifted upon reopening, dealers will be faced with a recessionary economy, lots of wage and job losses that aren't conducive to purchasing big ticket items like a car. Throughout the budget forecasts, we will have the ability, and we do fine-tune each of your city's forecasts. We've done that several times as we've gone along already. If one major industry group, business type, or individual business has a material impact or percentage of your overall sales tax database, we will and we can make modifications to fine-tune the forecast. Now moving on to building and construction. Once again, I wanted to highlight what our forecast was on March 11th when we began for this particular industry, which has also been significantly hit. The first quarter 20, we were projecting an increase of 1.5%. Second quarter, same thing, 1.5% growth. And as you see up on the screen there, we are now, first quarter 20, projecting -7%. Second quarter 20, which as Denise mentioned, that is the one quarter that has the biggest impact, and we're down 40% as an estimate, and then flat for fiscal year 2021. This industry has still been allowed to continue construction. Ongoing projects can be completed, but the question is going to be how fast can the construction crews get the work done? They are having to abide by the social distancing requirements. Some crews may be out, some people may be sick, the crews are depleted. There are a number of projects that have been on the books, and we feel that those can be completed. It just may be slower than it would have been before COVID-19. We're assuming that second quarter 20 with a reduction of 40%, and that's based on the possibility of major regional areas shutting down altogether. At the time the forecast was completed, entire regions had not yet shut down, but there have been construction stoppages in various regions throughout the state. The mayor of Los Angeles has called for a stoppage of some non-essential construction, and this is based on violations of the COVID-19 standards that have been established in LA County and in California. The construction industry has noted that housing in California significantly is down compared to the rest of the country. Permits are not getting pulled. They're continuing to trend downward. Some buyers are backing out of residential transactions. Developers are canceling projects. They're just not penciling out in this economic environment. Both residential and non-residential permits were already down in January 2020 when we look at the data compared to January of 2019. And this indicates that a potential slowdown already had started before the COVID-19 struck. With the stay in place order, there is so much less traffic on the streets, as you notice, if you go out to get that occasional tank of gas, which most people are not doing that right now. Everyone is required to stay home, so the streets are empty. We have had state agencies such as Caltrans taking advantage of the empty streets and accelerating projects. Funding is already on the books. They're getting the crews in place and they're advancing the deadlines. This may also be happening at the county level and at the local level. I know as we're talking to individual cities, if you have capital improvement project dollars that are on the books, the theory and the desire is to continue on with those projects. There is the potential as a result to advance streets, concrete, and paving projects, and that could have a positive impact to offset the declines in this industry. Moving on to business and industry, once again highlighting where we started on March 11th, first quarter 20, we were down 6%. Second quarter 20, we were down 4%. So we were estimating the beginning of a decline when we initially did this forecast on March 11th. However, this industry, as the other two industries that I've just talked about, significantly hit. First quarter 20, we're now projecting -15%. Second quarter 20, -30%, and a -5.4 for all of fiscal year 2021. At this time, we feel that most of the supply disruption problems will be resolved by midsummer, but cutbacks in customer capital investment plans will make for a slow and long recovery. The recovery will be agency specific, business, industrial, retailers, and we have examples of this. Reduced tax revenues for road construction will probably result in less investment in construction equipment. The shift to online shopping will maintain investment in warehouse-related supplies and equipment like forklifts, conveyor belts, and racks. Sales by agriculture and food processing equipment supply retailers, whose customer base includes a large percentage of export growers or food suppliers, will be down until the international economy recovers. And this is also impacted by many of the restaurants that are being shut down. And we'll talk about the impact on that industry as well later in the presentation. Use tax from high-tech companies competing through new innovations such as artificial intelligence will continue. Demand for labor-saving or job-eliminating technology will continue, including equipment to facilitate working at home by companies who are seeking satisfactory results from the current confinements and see opportunities to reduce office overhead costs. And the majority of us are all working from home. Most of us at HdL included in that group, and most of you have either a skeleton crew that's working at City Hall and the rest are at home. So I think everyone is adapting to that really well right now. As in previous downturns, the demand for expensive office furnishing will tank. Logistics and fulfillment centers that are point of sale in your individual cities will do well and help to offset the other negatives in other business types in this industry.
Before I proceed to talk about food and drugs, just wanted to remind you that you can submit questions as we continue in the presentation, and select the Q&A item on your screen, and then we'll handle them at the end. Okay, food and drugs. Our original projection for food and drugs was an increase of 2%. We've increased it to 5%. This is a result that grocery stores and drugstores are considered essential and have remained open. What will boost this category are taxable essentials along with alcohol sales. Alcohol sales may offset the loss of other taxable products such as hairspray and mascara. And I don't know about you, but there's not much need for that right now. And that's why we're really happy there's no video today. The spike in the holiday quarter is followed by a decline in the first quarter, which is typical in this pattern, as you can see illustrated on the screen. Some interesting statistics. In the last 4 weeks, purchases evolved from pure panic stock up with heavy focus on non-foods, taxable, to meal preparation ingredients, to increased focus on comfort foods, non-taxable. For example, chocolate chips and baking and cocoa sales are up 100%. The largest shopping day in this category was March 13th. One of the potential ancillary benefits is increased self-sufficiency and preparedness. We are all stocked up. This is really good news for all of our emergency preparedness professionals. In regard to future purchasing patterns, 23% of us are ordering more groceries online. 36% are very likely to buy groceries online after the stay-at-home restrictions are lifted. In addition, more than a third of customers will spend CARES stimulus money on groceries and household essentials. Extending out to at least a year after COVID-19 recedes, a vast majority of the food dollar will remain in the home. Cannabis, which is included in this category, is already a growth sector, and it experienced a virus-driven surge in March following a decline. However, specific performance depends on the customer base. For example, those regions with tourism will see a decline. In most cases, we see this category staying flat or decreasing less than 5%. And the other factor is that there will be less discretionary spending in the future that may influence future performance. Nonetheless, this group is the smallest share of overall sales tax, and therefore any fluctuation won't move the needle much. Statewide, this category is about 5% of overall sales tax. Fuel and service stations. This category has really seen a change in our forecast from the beginning. We originally forecasted in 1920 a decline of 5.1%, and we've dropped that to 16.5%. According to the Business Insider, the U.S. since mid-March, driving is down 63%, followed by a 81% decline in transit. We have also seen an ongoing downward pressure in fuel prices, which is the basis for our forecast reflected on the screen, with a 10% reduction in the first quarter, which is only a couple of weeks in March, followed by a 50% decline in the second and flat in 2021. The 50% reduction in the second quarter is probably a little more positive than what will actually occur based on the recent events. Also keep in mind that this category reflects not only retail service station fuel sales, but jet fuel, which impacts airport operations and revenues. Since the last forecast, the industry has experienced a lower demand combined with an oversupply of fuel. In addition, oil barrel prices have continued to drop and actually headed into negative territory this past week. The average price of gas in California has continued to drop. Regular unleaded as of April 20th was about $2.70 a gallon. What we've built into our projection an increase of oil prices in the first quarter 2021, this increase may get pushed out a quarter or two. Gosh, I feel like a teenager again. Low gas prices and grounded again. Okay. General consumer goods. This forecast shifted from a minus of 1.1% to a decline of almost 15% in 1920. The forecast reflected on the graph is shows a slow recovery until mid-2021. Keep in mind the retail mix of individual agencies will influence how the recovery will proceed. For example, non-essential retail has temporarily closed, accompanied by large retailer furloughs. Think Macy's, Kohl's, and The Gap as examples. The California forecast also reflects shutting down non-essential retail and impacting workers. About 621,000 workers in retail, in addition to another 320,000 in arts, entertainment, and recreation services. Stores that are opening are limiting their shoppers, reducing non-essential products, and adding one-way arrows on the floor, which seems to stymie me every time I go into one of these stores. Many categories should expect 50 to 70% declines in the second quarter 20 due to closures, unemployment, and the reduction in consumer confidence. Retail shopping is not expected to return right away once shelter-in-place orders are relaxed. Another harsh fact, according to Reuters, the U.S. decrease in March sales, a single month, was almost equal to the peak trough decline that unfolded over 16 months in the Great Recession. Isn't that a happy thought? In addition, increased unemployment will hold down discretionary spending and influence future spending, some of which is not taxable. As I mentioned earlier in the food and drugs group, in an increase in grocery sales. The most vulnerable sectors include department stores, home furnishings, furniture. In the US, that sector was down almost 27%. Apparel, shoe stores, bookstores, sporting goods, and jewelry. Unfortunately, Mother's Day is soon. However, big box discounters will see a gain. But be cautious, because those locations that have fuel sales, particularly Costco's, will be adversely impacted. The New York Times reported that Target sales have increased 7% since February. The makeup of that gain, however, is in-store sales dipped while online sales jumped 100%. This gives an example of the acceleration in the shift from brick and mortar sales to online shopping that will probably become permanent. Since 2012, the growth of online sales has outpaced the gain in brick and mortar receipts. Most trends, brick and mortar is flattening while online is growing. Despite the growth in online sales, brick and mortar still is the dominant way people shop.
Okay, moving on to restaurants and hotels. Again, I start by highlighting our forecast on March 11th. First quarter 20 and second quarter 20, we were projecting flat, zero, no growth. And now, first quarter 20, negative 10%, second quarter, negative 60%, which is the big quarter throughout, all industries being hit, and fiscal year 2021, negative 6.5% for the entire fiscal year. Restaurants, as you know, are open primarily just for pickup, takeout, and delivery. If there's any positive news out there or not, ABC has restricted their requirements at this time, so you can see signs out there such as margaritas to go, beer and wine to go, all throughout California. While restaurants can continue to do business, some smaller restaurants cannot sustain their business and cash flow, and they're just having to close the door, unfortunately. They just cannot withstand a long shelter in place. Many employees have lost their jobs, and that is the case in almost every major industry group that we're talking about here today. There is a possibility for long-term change in this industry. We have to see once the shelter in place is lifted, when people go out to eat, are they going to go sit down at restaurants? Are there going to be social distancing requirements that force restaurants to reduce the number of tables and reduce capacity? And if so, this will impact their bottom lines. And we just don't know how long it's going to take for all of us to go out there and patronize the restaurants again. There's a possibility that people will be more interested in quick service and drive-through restaurants and not dining in, and this was already happening before COVID-19. For individual business types in the industry, the casual dining area was already operating at slim profits. Rising menu prices were not enough to offset rising operating costs, so this group is vulnerable. That was happening before COVID-19, and even more of an impact now. For cities that have a high percentage of hotels within this industry group, the overall decline can be in the mid to high 80% range. Hotel vacancies are around 90%, and about 35% of hotels are closed altogether. So once again, a number of employees have lost their jobs, at least temporarily, if not permanently in some cases. Restaurants in areas with an airport or tourist attractions, they're also harder hit. We expect that once restrictions are reduced, restaurants will see at least an initial boost. I think all of us are anxious to get back out again. Local customers hopefully will be anxious to go out, but travel and hotels will have a longer recovery period. We expect that quick service and fast casual restaurants will perform better than other business types during this recovery. And once again, we have the ability to modify your forecast based on the makeup of the business types and the particular types of restaurants in this industry. So if you have a higher percentage of one type that might be doing better, we can help offset these decreases. And the same goes for every major industry group as we're analyzing your sales tax data and forecasting your budget. The next one that we'll talk about, and we have positive news, so we saved this one toward the tail end of the presentation, but state and county-wide pools have continued to grow. Wayfair decision that was implemented in two parts in calendar year 19 adds first time and permanent taxpayer dollars to the pool. AB 147 was implemented in the second quarter of 2019. The marketplace facilitator component started in the fourth quarter of 2019, and we now have a full implementation as of fourth quarter 19 of the Wayfair decision. Growth in the first 3 quarters that resulted from Wayfair was 14%, 15%, and 27%. Wayfair sales alone generate approximately 16% of the total pool sales. The estimates that have gone into our forecast include the focus of spending on essentials. Consumers are buying what they need. There is a continued accelerated shift to online sales. Businesses are practicing social distancing and in some cases are closing. And we're basing the estimate on product accessibility, how accessible those products will be to consumers. Again, we see this as a long-term positive, permanent growth that will outlast this current economic crisis. We are projecting strong growth, not only in the short term here, and you can see on the screen, first quarter 20, our forecast is showing a 15% increase, second quarter, 10% increase, and a little over 7% increase for all of fiscal year 2021. And we are projecting growth averaging 6% all the way out into fiscal year 2024-25. With the negative impacts that we're seeing in every other major industry group, with the exception of food and drugs, as Denise mentioned, that's being caused by COVID-19, we're very pleased to be able to report the significantly positive growth that's helping to offset the hits in the other industry groups. And with that, I will wrap it up now, and then we will start to take questions and make our best attempt at answering questions that you've been submitting throughout the presentation. When we met with all of you just 1 quarter ago, we said that we did not see an immediate recession on the horizon. We were looking 18 months out. We were seeing several industries that were still growing: business and industry, building and construction, restaurants and hotels. We're continuing to experience growth, although the growth was slowing. And we did have the pool continuing to experience substantial growth to help the overall financial picture for all of you. Most indicators at the time, a quarter ago, such as state and federal unemployment rates, gross domestic product, median housing prices, the number of California residential permits issued, and consumer confidence were all positive or growing and representative of a solid economy. And we said last quarter that unless something unforeseen strikes the economy all at once, then we will see a gradual slowing of the economy and not an immediate recession. And then, boom, COVID-19 struck in early March, and the world and the economy was severely shaken all at once. As a result, we revised our economic consensus forecast, as we've talked about quite a bit through this presentation. We don't normally do that. We normally do one forecast and we present the information to all of you for that quarter. But we met on March 11th. Fiscal year 19-20 estimated increase was a little less than 2% positive growth, and COVID-19 struck, had its downward pressure on the economy. We met again on March 20th, revised it downwards to negative 3.1%, and met again on April 3rd, and that's the forecast that is built into all of your particular budgets at this time and being fine-tuned, as I mentioned, based on individual changes within business types within each industry that we can do for your budget forecast. The shelter in place was required through May 31st, 2020. So the overall forecast revised down to 9.5% for all of fiscal year 19-20, and that was an 11.5% swing in just a 3-week period. The good news for all of you is we are continuing to monitor this situation on an ongoing basis. We're meeting as a group at least weekly and more if necessary. We're going to continue to provide all of our clients with timely information and give you our best estimate on the ongoing impact on all of your budgets. We wish all of you the best through this difficult time, and we look forward to continuing to work with you, whether eventually in person again or whether we continue the online meetings. We will evaluate that at the end of this quarter, and we wish you all the best of health during this financial crisis. And at this point, we will start to take the questions that you submitted during this presentation and answer them for you.
Also, I might mention, if you have a question, if you could use the Q&A tab on your screen and submit questions that way. The first question we have is, will the presentation be available later? Yes, it will be posted on our website. So you can go there and listen to us again. The next question is, have we looked at rental car agencies who are boosting the supply of delivery vehicles like Enterprise? I'm not sure what that question is. Car rental agencies right now, particularly at airport facilities, are down. And so we monitor that agency by agency.
The next question, is this based on your April 8th revision, or are there an even newer forecast? And as I mentioned in my wrap-up, the forecast that has been presented to you and that we're presenting to you quarterly is based on our most recent forecast that we developed as a team. So that was done on April 3rd. We have not modified that downward overall at this time. If there's something that materially changes, we will meet as a group. We will give you email blasts that we've been doing on a regular basis, and if necessary, we would modify the overall forecast. But at this time, it's based on the forecast that we developed on April 3rd and modifying it, as I mentioned, based on the business types specific in your individual cities.
The next question asked if the Beacon's economic section in our consensus forecast is still current. We are in the process of talking to them to get an update.
The next one, how did you evaluate supply chain interruptions, and what fields will be the most impacted and for how long? And I know Lloyd DeLamas is probably listening to this. This is his particular area of expertise, Lloyd. And basically, I know that Lloyd went through and did an analysis of every single individual business type in this industry. And so we've been able to take historical perspective of all the business types and build that into your forecast as we're going forward. So we have taken into account the supply side of this and when we think that will come back online. We'll get a better picture of that, obviously, as the shelter in place is lifted. We're able to go back out and see how quickly the supply side and chain comes back online.
We also consult and rely on industry publications and analysts in real time. So as soon as that data is available, we sort through it and consider that when we're doing our update.
The next one, why are you anticipating a significant downturn in auto sales the last 2 quarters of the projection, winter, spring 2021 downturn? Actually, the most significant downturn is at the tail end of 2020. And so first quarter and the beginning of 2020. So first quarter of 2020, the first 2 months of that quarter, we were seeing significant growth. We were thinking we were going to be able to present positive information to you before COVID-19 hit. The biggest impact has been in second quarter 2020, where we're showing overall negative of 55%. And then we do have negatives on into the last 2 quarters of 2020. So we have projected a little more than a 25% decline as a result for all of calendar year 2020. And then we start to see it pick back up in the later part of 21. And if you look at the forecast in second quarter 21, that is a very positive increase, and that's based on a couple of different factors. One is that second quarter 20, because it's so significantly hit, it's reduced the base down very far, and as a result, second quarter 21 is bumped back up, and that's the case in almost every major industry group. You're going to see significant growth in that second quarter of 21, and we also see the economy starting to pick back up. Right. That's the other factor. So those 2 pieces are factoring into that.
And keep in mind the autos and transportation group that we're talking about in aggregate includes new vehicles, used vehicles, leases, car rentals, and auto supplies and services. Our drive-through restaurants seem busier. Yes, they are. Are there any chains increasing in sales? In fact, Lloyd just passed around an article where some of them are offsetting some of their lower sales. The strictly fast food places are seeing a gain. How much of the forecast is based on a slow opening, fast opening? Just curious as to whether you think it may be slow and just what that may actually mean.
And it also has a commentary very depressing at the beginning of that question.
Well, yeah, I just didn't think I would add to that. Again, we forecast a complete shelter in place through the end of May, with a transitional opening over the summer. We'll probably be able to be much more specific once we get some real data as far as the first quarter cash receipts that we'll start seeing in May. I might also mention that the forecast here is based on the last actual data we have for the period ending December 30, 2019.
The next couple of questions. One, will this video and slides be available later? Yes, it will be available. We will put it online shortly after this presentation is completed. And then when you mentioned fiscal year 2021 restaurant and hotel sector being down 6.5%, is that 6.5% compared to fiscal year 18-19, or compared to fiscal year 2021, and it's compared to 18-19. So when we're looking at a particular quarter or a particular fiscal year, we're comparing that to the same quarter or the same fiscal year the year before.
It also mentions that this agency has a lot of hotels. The only sales tax reflected in this category are restaurant sales in a hotel, not the TOT. The TOT is a separate revenue source. But if a hotel closed and they have restaurant service, the restaurant service receipts is what is reflected in our restaurant and hotel information. Does sales from online sales go to the county pool only for out-of-state retailers? Yes, it's for out-of-state transactions, so online orders. The exception would be if there is a distribution center in California, then the sales tax would go to that location. But generally, out-of-state sales do get distributed to the pools, countywide pools, which are then distributed within each pool based on a prorated basis.
The next question, for those who received their fiscal year 2020-21 forecasts in February, when can we expect revised ones? We're doing them this quarter. We're also doing as many as we can and as quickly as we can early forecasts to get them out to you. And so you will be having.
I would say if you haven't had an update, contact the principal who provided that February update for you, and they can provide an update.
And the next one says, I'm with the City of San Diego. Thank you for putting this together. What are some of the trends you see municipalities implement to close the gap in lost revenue, such as TOT or business license? That's an economic development opportunity that you have within each of your community development staff, your city management staff, the city council leading the way. And we also provide services in terms of analyzing those TOT revenues for you. We provide services on the business license end of things. We have an economic development division as well that can assist with that. So
if you're talking on just the revenue side, that's correct. Most agencies, at least the ones that I've been talking to, they're looking at how they're either relying on reserves in the short term, or they're having to look at considering reducing services. Some communities are doing community meetings, talking with their business community and restaurants to talk about the transition to opening, which could help reduce the economic impact on the long term.
the next one is any sales tax collected from grocery delivery services, that is not on the food or items purchased, but the cost portion from the labor delivery. Now, services themselves are not taxable.
No.
The next one, what is the overall decrease for fiscal year 1920 and 2021 statewide, all groups combined? And for fiscal year 1920, our most recent forecast of April 3rd is a negative 9.5%. And for fiscal year 2021, for all states, all of our agencies, it's a negative 1.5%. The next one asks a question about no real estate data. This is not dealing with property tax, if that's what the question is referring to. We do have another division that does analyze the property tax, and if you're a client of HdL for that, we can provide the data for that. This is all sales tax.
Thank you for the presentation. Have you discussed or forecasted how long recovery will be For example, the last recession took about 3 to 5 years to recover. Wish I had a real answer to that. I think the optimistic economic projection is what's referred to as a V recovery. It's a drop that then goes back up very quickly. There are others that are more inclined to look at a U recovery, which is a little bit slower. In our forecast, we are assuming that by mid 2021 that we will be in a recovery mode.
The next question says, could you please clarify that fiscal year 2021 is or isn't 7/1/20 to 6/30/21? It is.
Mm-hmm.
Clarify why you are apparently not providing a 1920 projection, and clarify that the percentage you have for 2021 is using 1920 base. It is July 1, 2020 through June 30th, 2021, our fiscal year 2021 estimate. And the fiscal year 1920 would be July 1st, 2019 to June 30th, 2020. We do have some cities that are based on a fiscal year of September 30th, which we provide analysis for them as well. For all sectors, is the fiscal year 2021 growth or decline forecast compared to 1920 or 1819? It's compared to the immediate fiscal year before it, 1920.
Does the rate of decline projected reflect the nation or just California? Reflects just California. And California is forecast to bode much better than the rest of the country. Do you concur the U.S. economy is in recession? According to our police association, there is no recession. That's a hard one to answer. I think it is premature at this point. I think that to really get a good grasp on that, we're going to have to wait to see two things: what actual receipts end up being when the shelter in place gets lifted, and then see how quickly it comes back. I think that overall it's going to be, as we've talked about, industry and agency or regional specific. Those areas that are dependent on tourism is going to take longer to recovery. Think major events or crowd-based activities are going to take longer to come back online. But it really depends, I think, on the makeup of your overall economic base and getting some real data.
The next question: with oil markets decimated by political issues and now the complete lack of demand, is it realistic to expect fiscal year 2021 to be flat as opposed to significantly down? And I think Denise mentioned it during the discussion on this industry. This continues to drop weekly and daily in terms of the significant reduced demand because everyone is staying home, and the significant increase in supply where oil companies are having difficulty giving it away at this point. So I think as each of us are meeting with you to talk about your fourth quarter 19 and your budget, if there's an area where we could continue to decrease it even further, it would be in the fuel. Negative 50% in the second quarter of 2020 may end up being even worse than that, and first quarter and second quarter are continuing to not look very good. We did project oil barrel prices to come back up in 2021, and Denise mentioned that that may get pushed out a quarter or two. We're just continuing to monitor that. The market literally changes every day in terms of the future prices. And so we will continue to market that. We will continue to communicate that with each of you.
Has there been any work started on a model if the governor has to toggle back in the fall to more stringent social distancing again? We haven't projected anything that far in the future yet. There are too many unknown factors at this point.
The next one says, can you provide any info specific to the Bay Area? We do actually, because we provide services to cities and agencies all throughout California, and we do have specialists up in Northern California and Southern California, and we work as a team. We communicate regularly, and so Bay Area specific would be discussed with your, the individual that is coming out to talk to you, and so your representative can help you with that information, and all of us really can as well.
If you want some more specific information, go ahead and email me at Ovrum HdL, and I can see exactly what you're looking for. So please reach out and we can talk about it.
Next question, why do you consider the economic impacts to California to not be as extreme as to the rest of the nation?
We had a stronger economy at the get-go. We have a strong high-tech sector, and even though they're getting hard, they have continued to because they're in technology, they have continued to work. Also, they have provided, this sector has provided a lot of business to business services because of people at home. I don't know about your agencies, but we've tried to get our hands on video cameras for our staff who are working at home, and that's been very difficult. In fact, I couldn't get one for my house. So I think that sector will come back very strong. I just lost my other thought, but I think we have more resiliency. The other thing is, I think that will be a key factor, is particularly the Bay Area, California in general, has been very, very proactive in shelter in place early on. We've had reduced cases and deaths from the COVID-19, which means we can bounce back a lot quicker than some other regions in the country.
And the last question that we have is, do you have any diesel fuel information in terms of decline in forecast? And diesel, we do track that as well as regular fuel, and it typically is it trends with the oil barrel prices, and with oil barrel prices dropping down so significantly, we do expect the diesel prices to drop, and probably even more than the regular unleaded fuel at the gas tank. So yes, we do track diesel, and yes, it is significantly down.
And with that, I think we've completed the session. We appreciate your participating, and the questions and exchange is really valuable in helping to interpret the information we provided. So again, thank you very much. If you need any more additional information, don't hesitate to reach out. Thank you very much.
Thank you.